Afternoon, everyone. Well, we are living in a strange new world where I'm filming the Denver Gold presentation in Sydney. I must admit that I'm missing seeing all of you. I hope you're all doing well through this COVID pandemic and the strange new world we are living in. But I'm looking forward to the time when we can all meet again and engage on a personal level. I wanted to update you on where we're at with the evolution story. It's an exciting one, it's an interesting one, and I hope one which is consistent with what we've been telling you for many years. We're now a genuine mid-tier gold company. It's what we always set out to be, a globally relevant mid-tier. We believe that that means that growth is not for growth's sake, but it's for margin. Margin is much better than volume growth. And you can see that we have a 3-year outlook of a rising production profile, but most importantly to me is a reducing cost profile, which means that we are one of the lowest cost gold producers in the world. Good shareholder support from institutions, good liquidity, and a business that will prosper through the cycle. No amount of success, production or financial success, is worth anything if we don't do it in a sustainable way. And we need to recognize that really there are 3 core constituencies that need to believe that evolution is contributing to their success. Of course, you as shareholders are key, and that's measured in shareholder return and dividends. But secondly, our employees, are they safe? Are we making their environment safer? Are we giving them career and opportunities, personal and professional development opportunities? And thirdly, the communities in which we operate in. Are they seeing genuine long-term benefits from our presence? And will we leave a legacy with respect to our operation once it's completed that has made that community better? We are absolutely committed to achieving success for all 3 of those constituencies. I want to make just 1 or 2 macro comments before getting into the nuts and bolts of evolution again. The first is, I think something which if you weren't interested in, you wouldn't be listening to this presentation, and that's the case for gold. I don't think there has ever been a better case for gold since the US dollar was decoupled from the gold standard in 1971. US public debt now stands at $27 trillion. 20 years ago it was $5.7 trillion. And I think there is general consensus with these monetary and fiscal programs that are being rolled out, effectively printing money, debt is reaching an unprecedented and unsustainable level. Gold, of course, remains that one currency that cannot be printed. Another factor which I'm not sure is as front of mind for investors, but I think is going to be increasingly important, are geopolitical risks. I think, unfortunately, we're living in a world where geopolitical tensions are rising. Fractures and friction with China is increasing. And I think you are going to see increasing nationalism, or resource nationalism, growing tension, and growing shareholder value destruction where mines are located in jurisdictions where governments intervene unexpectedly. You've started to see that in certain areas, and that's why in time I think investors will start to value companies like Evolution, which has its assets in first-tier jurisdictions like Canada and Australia, at a premium, and location of assets will become increasingly important to investors. Since we have formed in 2010, we've had a very clear and consistent strategy. 6 to 8 assets, mid-tier, very rational view as to why we believe a mid-tier is the right space to be in. We can fund our own growth. We are still of the size where discovery can make a real difference, and we can develop a culture where people believe that they can make a difference and feel and act like owners of our business. So that's been the strategy from the beginning. It's meant that we've changed our portfolio as we've tried to improve the quality of our portfolio, and fundamentally recognizing that we're in a very cyclical business. We're in a very good part of the cycle at the moment, but at Evolution we want to build a business that prospers through the cycle. And that fundamentally means that quality drives value. All of our decisions are not about volume. Our decisions are about value and quality. That's how we've looked at changes through our portfolio, and that's how we look at this. You can see on the bottom left-hand side, and this is a chart of Australian producers over the last 5 years, and how we've changed our reserve prices. And we have had a very favourable Australian dollar gold price environment, but it is a concern to see that changes and adjustments to the reserve price have been up to 28% in the last 5 years. At Evolution, we believe that our reserves need to be calculated on a very conservative price. We use 1,450 Australian dollars a price. We've adjusted it only by $100 in the last 5 years. We won't be adjusting it for our next reserve update, which is due in the first quarter next year. We'll be using 1,450. And that's really a protection and a reflection of our margins. Margin matters. The other key drivers of value are reserves per share, or reserves per share, mineral resources per share, and then ultimately dividends per share. And you can see the upward trend of all of those as we've both benefited from the tailwind of a rising gold price and improved the quality of our portfolio. And we'll talk about that a bit later as we get into detail. The changes to our strategy, as I said earlier, have always been around trying to improve the quality of the portfolio. Fewer, larger, high-margin assets is much better than a large portfolio of large margin assets. We want to build a business that prospers through the cycle. So through our history of Evolution, which is only 10 years old, we've bought 4 assets, we've sold 3 assets. We've always tried to be counter-cyclical in buying assets when it hasn't been necessarily popular to buy assets. We've always looked at those assets and said, what value can we really deliver to those assets? And I'd explain at both Cal and Red Lake, MUNGARI and Ernest Henry how we're delivering value to those assets. We currently have 6 assets in our portfolio. We continue to look at things through that lens of, are we doing things which are accretive for our shareholders? Today's environment is not easy to find things that are going to be accretive to shareholders. I've said often that an acquisition is only going to be good for our shareholders if you have a motivated seller, and there's not many motivated sellers out there at the moment. Capital is available to juniors. The majors have largely sold most of the assets that they're intending to sell. And the other way you can deliver value, and I think in our acquisitions we've delivered on both of those. We've had a motivated seller and a geological view that there will be more ounces discovered. That latter part, I think, is still available, and we are looking carefully and selectively for opportunities which our discovery team think will deliver value through discovery. And then, cash flow is ultimately what we're in the business for. The gold business is no different to other business, and ultimately we need to deliver returns on the investment we make for our shareholders. At Evolution, we've got sector-leading cash flow per ounce numbers. That top right-hand chart shows that last year we made 728 Australian dollars per ounce for every ounce we produced, and we produced over 700,000 ounces. We made $728 an ounce free cash flow. That was after all our capital investment and everything. And we delivered $360 of that back to our shareholders as a dividend. You know, we're a business that is focused on the two things that, to us, drives value. Cash flow per ounce and discovery of new ounces so that we replenish those ounces that we have monetized and put in the bank. And we always drive our strategy and our balance sheet, to support our strategy. We never want to be in a situation where our balance sheet drives our strategy and we're forced to sell assets at a time which is not opportune for us. So we run a conservative balance sheet. It is in very good shape. This week we are paying out our 15th consecutive dividend. Our yield on a dividend yield basis is now close to 3%. We're paying out 14% of our revenue as dividends. We have a policy of paying out 50% of free cash flow. And we think that just makes good, rational sense. When the gold price is high, we need to be making exceptional profits and cash flow. And we need to be delivering that back to our shareholders. We need to be investing for the future, but shareholders ought to be benefiting through both dividends and capital growth on a consistent and continuous basis. So let's now briefly talk about our assets, because I think there are some changes in these assets since the last Denver Gold Show that are both interesting and really value accretive from a shareholder perspective. Cowal was an incredibly transformative acquisition that we made in 2015. At the time, it had 1.6 million ounces. Today, it has 4.4 million ounces. The mineral resources in 2015 were 3.4 million ounces, and today it's 9 million ounces. The mine life in 2015 was 9 years. Today, we believe it's at least 12 years. We're starting to think that it's around 20 years. We'll talk a little bit about the discovery of this underground opportunity, but the underground opportunity today, the GRE 46 ore body, is close to 3 million ounces of resource. We declared a maiden reserve of close to 1 million ounces, just over 800,000 ounces of reserves. And we think that reserve and resource space will grow because the ore body is open at depth and along strike. Plant throughputs increased from 7.2 million tonnes to 9 million tonnes. We've produced 1.3 million ounces of low-cost gold. And for an asset that we acquired 5 years ago for $750 million, we've delivered net mine cash flow after all this capital investment of $731 million. So from an investment perspective, if you talk about return on investment, it's been an incredibly successful investment. And we believe we're sitting on a real opportunity for more discovery and more value creation as we take the operation from its current around 220,000, 230,000 ounces of low-cost production to 350,000 ounces, which is the next stage of the Cowal development. So that journey from the current production rates to the 350,000 ounces is underway. It hangs off and is predicated on the discovery and expansion of this underground deposit that we have found, the GRE 46, which will allow an underground mine to be developed. We're thinking a throughput or an extraction rate, a production rate of around between 1.5 and 2 million tonnes. At the moment, we've completed the pre-feasibility study. That allowed us to declare that maiden reserve of 800,000 ounces. And we're now moving into a feasibility study and continuing to drill extensively. And as I mentioned earlier, the deposit remains open at depth, along strike, and infill drilling will increase the reserve base. We're thinking that we'll submit for our application for government approvals early next month in October, and we're hopeful that the New South Wales government, which has been very receptive to shovel-ready projects, will allow this project approval to be accelerated, and we'll get an approval in the first half of next year. Our drivers are that we want to be producing the first ore from this mine 12 months after we get the approval. So all the feasibility work, all the work on the development of this mine and preparation for construction is predicated and driven towards getting first ore production 12 months after government approval. Let's turn quickly to Red Lake, which has been a really transformative transaction for us, and in my view, the best value-creating opportunity within Evolution that it's acquired, I should say, since Cal and since Ernest Henry, because I'm going to talk about them, about Ernest Henry in a few minutes. But these are assets which I think are going to be cornerstone assets for Evolution over the long term. Red Lake, we acquired it in November. We signed the deal to acquire it in November last year. We've spent over 10,000 person-hours redeveloping or changing or aggregating the database. I think there's 6 million samples, 7,000 assay results. There were 142 different block models. And I think what we're bringing to Red Lake is looking at an opportunity through a completely different lens. Because in the past, Red Lake was considered, ore grade material at Red Lake was considered anything 15 grams or above, extraordinarily high grade. Anything less than 3 to 4 grams wasn't sampled, and you had a psyche that suggested that if it wasn't going to be 15 grams, it wasn't going to make the mine plan, and therefore it wasn't going to be developed. Now, what's happened as the mine was underdeveloped or underinvested in over the last 5 years since the high grade, that famous high grade zone ran out in 2016, that underinvestment led to, in my view, an acceleration of complexity and difficulty in extracting mineralization from these 142 different block models. 5 different shafts were operated, 2 different mills. There were multiple areas of the mine that were the mine plan became increasingly more complicated as you really picked the eyes out of the ore body, and there was an underinvestment in drilling and development, so that the complexity of the development and mine plan became increasingly difficult. The mine consistently didn't meet its targets and needed a complete reset. This new resource base that we have established in simplifying these 142 different block models down to 19 has meant that we have defined an 11 million ounce resource base. It's over 7 grams a ton. Very interestingly and encouragingly is this 4.3 million ounces at 10 grams per ton, which is near surface in the upper Campbell area, and which will be a real priority for us. So initially, the idea at Red Lake was the investment case that we made to our board and our shareholders when we acquired it, and we got official ownership on the 1st of April, was a 200,000 ounce a year production rate at less than $1,000 an ounce. With this new mineral inventory of 11 million ounces at 7 grams a ton, we have now set a more ambitious longer-term target of getting this to 300 to 500,000 ounces a year of low-cost production, sustainable over the long term, and we believe that that is imminently achievable. Let me tell you briefly about some of the changes that have happened at Red Lake already, because a lot of the things which we thought were going to be really difficult, frankly, have been embraced by the team on site. We've done a significant workforce restructure. When we signed the deal, there were over 1,100 people employed at Red Lake. I heard this morning that there were just under 700 people on site at the moment. So it's a very significant workforce reduction. We've completed a major shut of the Campbell Mill, spent $5 million improving the availability, and we've put the Red Lake Mill on care and maintenance only to be used as surplus capacity once the mine can deliver sufficient tons to warrant it being opened. We continue to rationalize the infrastructure, and most critically and importantly, we need to develop access to more areas in the ore body. We are mining in fewer areas, but we need to develop mineral inventory that allows us better access in fewer areas. And that's happening, and you can see the development meter increases over time. A short period of time, when we took it over, it was doing 600 meters. Our near-term target is 1,200 meters, and then we want to take it to 1,500 meters a month. All of the equipment or infrastructure or skills are really there on site. Yes, we're changing bits and pieces of equipment and we're going to more productive gear. But fundamentally, we need to make delivering 50 meters a day of development a habit. We've done it on previous occasions, we've done it on various days, but we need to start making it a habit. And that's going to require a change in culture, which is underway on that site. And as I said earlier, you know, we've been surprised and encouraged with the enthusiasm and the engagement with which the site team has embraced change, because I think, frankly, that a lot of the changes that we're suggesting need to be made, and they're suggesting need to be made, I think were quite well known for a long time. So the Red Lake Phase 1 transformation is this delivery of taking it to 200,000 ounces of production at less than $1,000 an ounce. And that is underway. We've given ourselves a 3-year time horizon to deliver that. We're well on track, and in fact probably ahead of where we expect it to be. And then the next stage, the next horizon, is the next phase, which is 300 to 500,000 ounces of production. And again, the planning has started. It's probably going to require, the early stage thinking is decline access into the upper Campbell area, and then that will move this mine from being mine constrained, ore constrained, to mill constrained. And that's the challenge that we're giving the team on site, to really give us the momentum and force us to increase the milling capacity, which is currently, if you take the Camel Mill and the Red Lake Mill, 1.1 million tons per annum, and we'd love to be given the momentum to change that milling capacity through being mill constrained in due course. I think it's worth just quickly touching on Ernest Henry. We have an economic interest in this, where we get 100% of the gold and 30% of the copper. It's a fantastically operated mine by Glencore. It's in North Queensland. There is a significant drilling program underway to extend the reserves below this 1,200 level, where our economic interest changes to 49% of the gold and copper. But the cash flow generation of this asset has been extraordinary. We have generated, we acquired it in November 2016. We paid $880 million, and it's already delivered $779 million, or 87% of that capital has been returned. It has a mine life out to around 2024, 25. That's in the known reserves, and then this 18,000 meter drilling program will extend it beyond that. And we're optimistic that there will be a reserve increase when the next reserve update comes out in the March quarter of next year. MUNGARI is an asset that has really gone through a transformation of its own. It was a troubled asset a couple of years ago, and similar to what needs to happen at Red Lake has happened at MUNGARI. A change in the team, a change in the culture, a real momentum shift, and operational improvements. And that's resulted in us feeling very confident that MUNGARI has a much longer term horizon of production at that 110 to 120,000 ounces a year. We believe it's now within our orbit to deliver on that and execute on that. And we think that's very achievable. Discovery is ongoing over there. We have a resource base of 2 million ounces. and continue to be attracted to this highly prospective field, which, as I say, now has the culture and the operating team that can deliver. So I think that wraps up the presentation, but just leaving you with the final few thoughts, which I hope have been consistent messages, for those of you who know evolution, for those of you who are new to evolution, that this is a company where quality drives value. Our culture is critically important to us. We have a culture where we want every person in the organization to feel like they can make a difference. We have an Act Like an Owner program, wanting every person to feel and act like an owner of the program and to treat every dollar that they're spending on your behalf as a shareholder as their own. We want a culture which pushes people to the limits of their personal and professional capacity, that gives people opportunities, and that ultimately will then deliver superior shareholder returns for you, our shareholders, for the communities in which we operate, and give those opportunities to our employees. So thanks very much.